Look, I need to be completely honest with you right now. Most people who want to build a strong investment portfolio never actually do it. Not because they lack intelligence, not because they lack money, but because nobody ever sat down and explained it to them in a way that actually made sense. And that is exactly what we are going to fix today. If you have ever stared at your bank account wondering whether your money is working for you or just sitting there slowly losing value to inflation, this video is going to feel like it was made specifically for you because it was let me paint you a picture. Imagine waking up 5 years from now and realizing that the money you had today grew quietly in the background while you slept, while you worked, while you lived your life. No stress, no confusion, just results. That is not a fantasy. That is what a properly built portfolio does for ordinary people every single day. But here is the painful truth first. Most people spend their entire lives trading time for money. Every single hour of work, every exhausting week, every missed family dinner, every vacation you could not afford, it all adds up to one brutal reality. Your money stops the moment you stop, and that is a trap. A quiet, slow, suffocating trap that millions of people are living inside of right now without even realizing it. You work harder, you earn more. But somehow the financial freedom you imagined never arrives. The bills do not shrink, the savings do not grow fast enough. The retirement goal keeps moving further away like a horizon you can never quite reach. Sound familiar? Because if it does, you are not alone and you are not failing. You were simply never taught this. Now before we go deeper, we have related programs linked down in the video description below. These are designed for people who are serious about accelerating everything we are going to talk about today. Do not let this moment pass you by thinking you will come back to it later. Later rarely comes. Check the description now and keep watching. Alright, let us get into it. Step 1. Understand what a portfolio actually is before you build one. A portfolio is simply a collection of investments. That is it. Stocks, bonds, real estate investments, index funds. It is just a group of assets you own that are meant to grow your wealth over time. Think of it like a garden. You plant different seeds in different spots. Some grow fast, some grow slow. But together they produce something that one single plant never could. The average person hears the word portfolio and immediately thinks it is for rich people. That is the biggest lie the financial world has ever told. Portfolios are built by ordinary people, consistently, over time, with whatever they have available right now. Step 2. Start with what you actually have. Here is where most people get stuck. They wait for the perfect moment. They wait until they have more money, more time, more knowledge. But every single week of waiting is compounding in reverse, meaning the longer you wait, the more ground you have to make up. Research consistently shows that people who begin investing even small amounts early dramatically outperform those who wait to invest larger amounts later. We're talking about the difference of potentially tens of thousands of dollars over a decade, sometimes hundreds of thousands, all because someone started before they felt fully ready. You do not need to be perfect, you need to be present. Step 3. Diversify like your financial future depends on it. Because it does. Putting all your money into one investment is like building your entire house on a single wooden plank. One crack, and everything collapses. Diversification is the art of spreading your investments across different categories so that when one area struggles, another area holds you steady. Think about the people who had everything in one company's stock and watched it disappear overnight. Then think about the people whose portfolios barely flinched during the same market event because they were spread across multiple asset types. The difference is not luck, it is structure. A well-diversified portfolio typically includes a mix of growth assets like stocks and index funds, stable assets like bonds or treasury securities, and sometimes alternative assets like real estate investment trusts. The exact combination depends on your personal goals, your timeline, and how comfortable you are with risk. Step 4. Know your risk tolerance and be brutally honest about it. This is one of the most underrated pieces of building a strong portfolio. If you build a portfolio that causes you to panic every time the market dips, you will make emotional decisions. And emotional decisions in investing are almost always expensive ones. Ask yourself honestly, if your portfolio dropped in value by 20% tomorrow, what would you do? If your honest answer is sell everything immediately, then you need a more conservative portfolio. That is not weakness, that is wisdom. The goal is a portfolio you can hold through turbulence because turbulence is guaranteed. Markets go up, markets go down. But historically, the market has always recovered and gone on to reach new highs. The people who build wealth are not the ones who predicted every dip. They are the ones who stayed in the game long enough to benefit from the recovery. Step 5. Automate your investing so your emotions cannot sabotage you. This is one of those strategies that sounds almost too simple, but the results speak louder than anything. Setting up automatic contributions to your investment accounts removes the human temptation to time the market or skip a month because something came up. People who automate their investing consistently build larger portfolios than those who invest manually. Not because they are smarter, but because the system does the work even when motivation runs low, even when life gets messy, even when the news is frightening and every instinct says to pause. Automation turns investing from a decision into a habit, and habits compound just like interest does. Step 6. Rebalance regularly without obsessing over it. Over time, your portfolio will naturally drift. One asset class will outperform another, and suddenly your carefully designed balance is off. Rebalancing simply means bringing things back in line with your original strategy. This does not mean watching your portfolio every day. In fact, checking too frequently is proven to lead to worse decisions. Most financial research suggests reviewing and rebalancing your portfolio somewhere between once and 4 times a year, depending on market conditions and your specific situation. Think of it like maintaining a car. You do not rebuild the engine every week, but you do not ignore it for 5 years either. Regular, calm, intentional check-ins keep everything running smoothly over the long haul. Step 7. Invest in financial education the same way you invest money. Here is the shift that changes everything for people. The people who build the most successful portfolios are not necessarily the ones who started with the most money. They're the ones who consistently invested in understanding how money actually works. Financial knowledge compounds the same way financial assets do. Every concept you truly understand creates a foundation for the next concept. And over time, the gap between someone who actively learns and someone who passively drifts becomes staggering. We are talking about years of unnecessary struggle on one side and accelerated results on the other. The cost of ignorance in investing is not just a number on a spreadsheet. It is the vacation you never took, the house you could not afford, the freedom you kept postponing, the relationships strained by financial stress. Those are the real costs that nobody talks about. But the return on actually learning this? It shows up in your confidence, in your clarity, in the way financial stress slowly lifts off your shoulders as you realize you actually understand what is happening with your money. And that brings us to right now. You have made it to the end of this video. That alone tells me something about you. Most people drop off, they get distracted, they assume they will finish it later. But you stayed. You are serious. And serious people deserve serious resources. The programs we have linked in the description below are not for everyone. Honestly, if you are comfortable staying exactly where you are financially, do not even bother looking. But if something inside you recognizes that the information in this video is just the beginning of what is possible for you, and you want to go deeper with real guidance and proven frameworks, then the description is where you need to go right now. Not tomorrow, right now. Because the people who transform their financial lives are the ones who act on the moment instead of letting it fade. Go check it out.